This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. I know that here on the show, we talk a lot about the importance of bank partnerships when it comes to the success of any type of embedded finance or fintech endeavor. So let me tell you about a provider that is raising the bar in embedded finance. Built by Fifth Third Bank, Newline enables enterprises to launch and scale payment products using their API-first platform, enabling embedded solutions that scale responsibly. Learn more about Newline by visiting newline53.com. Hello, and welcome back to Bank Nerd Corner. My name is Alex Johnson, and I am joined, as always, by the Banking and Fintech Editor at Bank Director and number one among all bank nerds, Kiah Haslett. Kiah, great to see you again.
Hi, Alex. How are you? It's good to see you last month.
It was good to see you. I was just going to say I'm good, but like that we're seeing each other remotely, which feels weird and less good than when we got to hang out in New York together. That was super fun.
Yeah, that was really fun. There's nothing like being, and I'm sure this happens to you too, where people just walk up to you and they're like, "Hey, I'm a big reader," and it's like, "Hi, what's your name? Where do you work?"
Yes.
That was really fun to see everyone in person and to feel like you take your chat DM conversations and have them in real life. And then the bank nerdery was so high. People just came up to us and were talking to us about the SCA, which we'll probably talk about today, and Synapse. It just felt like a big group conversation around our favorite topics.
It really did. The bank nerd energy was quite extraordinary, I have to say. And I don't know why at Finovate necessarily the bank nerd energy was so high. Like, I kind of think of Finovate in, I guess, the way it used to be sort of framed, which was like, this is the coolest corner of banking and fintech. And I think as Finovate,
cool.
Well, I mean, so first of all, Kiah, you and I are not cool. Let's just get that out of the way right away. But second of all, I also think it does speak to like the interesting innovation of Finovate and that corner of the financial services universe, because now it's like Finovate is old. It's like an old show. Like when I talk to people about like when I demoed at Finovate a million years ago, like it is kind of like talking about ancient history in fintech, even though it doesn't feel that way to me. But I think the benefit of that is that it does attract a much more sort of serious and nerdy caliber of attendees. We had lots of interesting conversations with bankers. Mm-hmm. There were regulators there. There were fintech executives, but ones who like listened to Bank Nerd Corner who were there. So it was a very different energy. And I will plus one your statement about the sort of surreal nature of talking to people who read what you write or follow you on Twitter or whatever. In person, because it's most of what we do is just like one-way communication. Mm-hmm. Like we send thoughts out into the universe, so it's always nice to talk to people who are on the receiving end of those thoughts.
Yeah, I really recommend it. And it was, I will talk about banking with anyone. So it was really fun to live in that headspace for a couple of days. I do feel kind of bad because sometimes I can't like turn it off fully or like come up with anything else to talk about.
You had an energy to you. We had lunch with another one of our bank nerd friends, and I got to the lunch a little late. And what were you guys talking about at lunch when I sat down at the table?
Were we talking about shares or dividends or
it was like very
capital planning?
And you had like your arms up and were like gesticulating wildly, and the volume at the table was very high, and I sat down and I was like, how long have you been here? It's like 5 minutes or so. Like that was the kind of like bank nerd energy. So Kiah, we're going to try to carry that forward to today's conversation, which I feel very confident in. As always, we are going to review a couple of things that have been kind of in the news. And then we are going to save a little time for some questions that we want to poke at a little bit. And I'm going to try to see if I can coax Kiah into a ranting mood by the end of it. Does that sound good, Kiah?
Sounds good.
All right. So let me give you the first story. And I'm giving you this story, Kiah, because you have expressed to me a anger, I think is the right word, that I sometimes steal the juiciest topics for podcasts and give them to Mr. Mikula for FinTech Recap. So
Mm-hmm.
even though I did do that in this case, I wanted to resurface a topic that Jason and I talked about, but I very much want to hear from you on, which is the synapse rule proposed by the FDIC, or as I am petitioning folks to call it, the Henrichs rule, after our other friend Jason Henrichs at Alloy Labs, who has been ranting about this topic, I think, longer than any of us. As listeners of this podcast in particular probably are aware, the FDIC, it was reported a little bit early, actually, by Evan at Bloomberg, that the FDIC was going to be proposing a new rule that would essentially govern the way in which banks have to maintain records around a particular category of these sort of omnibus accounts that they use with fintech programs. And they did indeed, as Evan reported, they would introduce what they're calling a proposed rulemaking on requirements for custodial deposit accounts with transactional features and prompt payment of deposit insurance to depositors. That is a very interesting title. I want to give you credit, Kiah, because you were one of the first people I talked to who made the very important point that custodial accounts or omnibus accounts come in lots of different flavors, but that traditionally, historically, they have not been used to facilitate transactional banking activity as they are in fintech. A lot of transactions. And so when you and I and Jason Henrichs and Jason Mikula and others talk about concerns about FBO accounts as a category, I suppose, of these omnibus accounts and their sort of insuitability for banking as a service, that was really what we were referring to, right? Is that they're being used to facilitate massive volumes of transactional activities. And that just creates sort of an inherent risk that something is going to break or go wrong or get lost track of, which obviously we've seen in the case of Synapse, hence the reason why some folks are calling this the Synapse rule. So essentially, my understanding of this proposed rule is that it defines what a custodial account with transactional features is. It requires insured depository institutions that have those types of accounts to maintain records that would identify for each custodial deposit account the beneficial owners of those accounts, the balance attributable to each beneficial owner, and the ownership category in which the beneficial owner holds the deposited funds. It stipulates that maintaining certain internal controls is required, including maintaining accurate account balances, including their respective beneficial ownership interests associated with each account, and conducting reconciliations against the beneficial ownership records no less frequently than at the close of business today, which, again, going back to Evan's initial reporting, essentially means that you either, as the bank, need to maintain the ledger yourself, or if you're not, that you are reconciling it against that ledger of beneficial ownership interests on a daily basis.
Yeah.
So this is all obviously being done in response to Synapse. Statements from different FDIC directors, including Grunberg, Hill, McKernan, Chopra, all specifically talked about Synapse. I thought Chopra's comment about there being a significant incursion, quote unquote, into deposit taking by firms that are not banks and credit unions was a pretty interesting choice of words. Significant incursion. You don't always hear that, but I suppose when you're talking about a regulatory perimeter, an incursion of that perimeter would be how you would talk about it.
I think about it as osmosis, like cellular membrane, the movement of activities.
I like that better.
Yeah.
I like that because it is
breaches.
Well, it is more of a permeable barrier, I guess, to your point, right? So it's not like a big high wall that they somehow like broke past, like they're inside the perimeter. So I think that is they breached the perimeter. So I think I like that framing a little bit better, honestly. Now, interestingly, the board voted 5-0 in favor of introducing the proposal, which I don't think I was terribly surprised by. I think I've commented in the past that even sort of Republican prudential bank regulators, I think, are probably pretty anti-Synapse and this whole situation happening again. So, yay to Synapse for creating a little bit of bipartisanship here. The two Republican board members did express some reservations about maybe waiting for the bank fintech RFI that the agencies are currently fielding to get some data back. Perhaps suggesting that there might be threshold requirements for when the rule would apply. So little nitpicks, but in general, it seems like this has the unanimous support at the FDIC. My sense is that the broader regulatory community is also supportive of this. I find it to be a little bit bizarre, quite frankly, just in the sense that it's shocking we need to have a rule that says these things, because this would seem like a very obvious best practice. Obviously, we know that wasn't the case. But Kiah, after having some time to sit with this and digest it a little bit, what's been your kind of main takeaway?
So I both agree about the codifying best practices. I think if I'm reflecting on the principles-based regulation that regulators try to issue and give banks, allow banks to do it the way is best for their institution, and avoid giving process and procedure, prescriptive guidance. The fact that there's prescriptive guidance means that I kind of feel like you're in trouble and you will do it this way, versus in where we've seen, do it the way that makes sense for you and according to your risk appetite and your capabilities. So I do think that and I also think that this rule comes after years of bank regulators issuing their bank fintech guidance. There's like 3 or 4 different iterations of bank fintech guidance, each of them I think getting a little bit longer, the tone of which is changing a little bit every time. It's getting a little bit more, we're not trying to help you, we really do need you to manage some of these risks a little bit better. And we're finally kind of getting to maybe what I would say is like a natural consequence of that trajectory, which is actually you will do it if you are going to use the custodial accounts with transactions or whatever, transactional features, you will do it this way. And we're not saying this is how you have to run your BaaS program, but if this is how you run your BaaS program, this is how you're going to have to run it. And this is what we will need to see from you. I also think it's really significant that the FDIC is understanding that there are some weaknesses with how these accounts are being managed from a safety and soundness perspective and their ability to pay out deposit insurance. And that's probably something that needs to be rectified just from a FDIC policy perspective. As far as thresholds and, maybe smaller banks having different deadlines or different requirements to do this, I do think that something that's very interesting is, again, deposit taking BaaS programs are so concentrated among the $10 billion in bank threshold that I find that to be kind of a disingenuous argument. If you are a small bank, if you're a $1 billion bank that wants to play in BaaS, you're just now you're doing a more complex business line. You can't really use your asset size anymore to indicate that you are not a sophisticated bank. And I'm just not very sympathetic to that argument. And I wouldn't want to see it made.
Well, I mean, so this is a funny way of thinking about it, but I almost wonder if we should think about it as a reverse threshold. The smaller you are, if you're going to do this, the more we think this should apply to you rather than the reverse, right? Because if you're a bigger bank that's playing in banking as a service, and we're seeing more and more of that, I think they would just by a natural consequence be like, yeah, of course we would do this. It's insane not to do it this way. They would have more of that established best practice mindset that we were talking about.
Yeah.
I think this rule, to your point, is squarely aimed at banks under that $10 billion threshold, under a $5 billion threshold. They're looking at banks that probably had no business being in banking as a service in terms of their sort of operational and compliance readiness and just sort of systems and processes, that this feels very much like it is intentionally aimed at that. So I would agree. I find the threshold argument here really kind of strange. And it is sort of an interesting broader question, which is is it possible that just as fintech and digital technology and stuff sort of flattens out banking, and every banking institution across the country sort of has access to the same pool of opportunities as everybody else? I kind of wonder if we need to distinguish regulatory rules and guidance based on asset tiers. I wonder if that changes more broadly, because you hear smaller banks talk about it a lot, which is we don't want to be regulated. It's complex for us to have to take on this regulation. It's expensive. It makes us less competitive, blah, blah, blah. You hear that a lot, but I think a natural skepticism I would have if I was a prudential bank regulator coming out of all of this would be, just because you're small and you don't want to take on compliance obligations and it's more difficult for you to take on compliance obligations doesn't mean that you have some natural limit or inherent barrier to taking on the most complex risks in the market.
Yeah.
Whereas, before, I mean, going back into the very old days, if you were a bank based in New York City, you sort of had access in your own backyard to more complex banking opportunities and risks. Whereas if you were a bank in, Helena, Montana, you probably didn't. And so there might have been a little bit more of a sort of reason to kind of draw certain lines. But I don't know. I wonder if the threshold argument may evolve in a broad way coming out of banking as a service.
Yeah. Actually, Governor Michelle Bowman gave a speech just this week, about discussing supervisory and regulatory understandings of banks' complexity around, I think, 10 billion, because you do have some banks that are over 10 billion that very much function like a community bank. And
Sure.
You have a lot of banks under 10 billion that increasingly don't look like community banks. And I think while for maybe 75% of banking, an asset threshold is like an appropriate proxy for risk, that there's like, the arbitrage or what's being missed for the last 25%, where there's just not a good proxy of their relative risk and complexity and their asset size. And you would just want to make sure that you have a different way to think about that. Obviously bank regulators have come out with their supervisory groups for the tech banks.
Yeah.
And it'll be interesting to see what characteristics that they come up with that would indicate a bank is small but increasingly complex.
No. I totally agree with that. The other thing I was going to add is, I don't know if I haven't read Michelle Bowman's speech, but I was wondering, did she mention Silicon Valley Bank in that? Because that was another example of them sort of sitting outside of a line that had been drawn and that moved, but they were a high risk. They're weird.
Well, the other thing about SVB, and I think about this a lot too, is like transitions are risky, right? Like,
right, sure.
When a bank is moving between thresholds, so we see this a lot, between 8 billion and 12 billion. And we used to kind of see it around 50 billion before that asset threshold went away. And SVB was transitioning into a higher supervisory tier for their asset size. We haven't had a lot of banks do it. And obviously SVB kind of failed before they fully made their transition. I believe her speech was at the Federal Reserve Bank of St. Louis's community banking conference that's held in conjunction with the FDIC and the Conference of State Banking Supervisors. So it was more focused on the community banking space and how regulations are impacting community banking. She also specifically highlighted that the proposed CRA rule establishes $2 billion in assets as the largest asset threshold size for CRA examinations. So it wasn't SVB focused. The one thing I wanted to add about the critique about waiting for the RFIs to come in for this rule is like, sure, fine. I think there's, to whatever extent that that critique is being offered as a delay tactic, I don't like. I also don't know what the RFI is going to tell us that would relate back to this proposal. I think, if the RFI, if a bank that uses this, the custody accounts with transaction features wants to share with the FDIC how they manage it and wants to say, well, here's where your proposal and our practice are in common. Here's actually what you've suggested doing a little bit more work. We've actually found maybe the way we do it is gets us kind of to the same result, but less work. That's fair. I just kind of don't know to what end the RFI is going to like address this. This rule should have been in place 5 years ago. This,
Totally.
I kind of don't. I don't think one more day, one more week is a really acceptable. And it's been proposed. It's written. The banks that use this account structure to manage their banking as a service businesses need to start working on it today. And then we'll figure out what changes between the proposed rule and the finalized rule. But they need to start working on this to go into compliance today.
Well, and I think to your point, I mean, yeah, the waiting for the RFI responses. It's like, guys, the jury's back on this. Like, this is such a simple, obvious rule, and we know exactly what the worst case scenario of this looks like, thanks to Synapse and Evolve and everybody else. Like, we have all the data we need, right? Like, this isn't like I was much
Yeah.
more sympathetic to this with like the broker deposits discussion when it's
Yeah.
like we really don't have a lot of good data, and it would be nice if we had it. It'd be nice if they shared the data publicly, and we could have like a robust debate about it. This isn't that. This is we have plenty of data, we have plenty of public evidence. This is such a simple, straightforward rule that probably should have been followed anyway, even though it wasn't a rule before. Like, it makes all the sense in the world. I think to your point about banks coming into compliance with this, one of the big sort of unknown questions to me about this is how it will adjust the approach that banks in this space take from a
Hmm.
technology perspective. Because I think, I mean, the whole sort of premise of allowing this account structure to work in a transactional banking capacity is because banks' legacy core systems are terrible
Yeah.
and expensive and difficult to manage, difficult to integrate with, all these different things. And that's not going to change. I do wonder, though, if you might see banks that are getting into this space or who are doubling down on this space
Hmm.
and saying, no, we want to be in this for the long haul, if they might evolve from, hey, we were, reliant on a mix of different ledgers from different parties that we were trying to reconcile against, and that was
Hmm.
creating complexity. And it really would be very difficult to change the way we're doing reconciliation or do it more frequently, or we're worried about its ability to scale, particularly in compliance with this rule. And if they just bite the bullet and invest more in technology themselves, and that doesn't mean ripping out their core general ledger, but I wonder if we see more kind of sidecar
Hmm.
cores specifically for BaaS, if we see the bank essentially use its leverage that it now has in BaaS, given that we've seen a crunch on the supply side, to basically say, no, fintech company, if you want to work with us, this is how it's going to be. We're going to be a lot less flexible about integrating with and reconciling against whatever technology you want to use.
Yeah, I think that it is interesting. Again, BaaS is like not super new.
It's
I think
not.
about it in eras and waves, and we're probably in that third wave right now. So there's been a whole two waves before this. I do think it
What
is
did you decide? What did you decide we're calling the third wave, by the way? Remind us.
Henrik's is going to call it something. I'm not that clever at catchy names.
You don't like to name these things? Okay.
But that the tech stack is actually going to be probably increasingly important, and
Yeah.
that's not maybe something regulators should be weighing in on, but maybe there is some group that can put together a recommendation of the stack and the capabilities and who are the vendors that are providing this. And I mean, it kind of all just comes down to like, I don't know, like required reading or something at the end, right? There's a way
Segue,
to do
segue.
this.
That
And
was a segue. You just segued us to our next story. Don't think I didn't notice your very subtle way of like dropping a hint that we should move on to our next story. That is a perfect transition, Kiah, to our next story. Do you want to introduce that one?
sure, this is not necessarily news alerts. It's more of an observation of something I'm seeing, which is
Yeah.
all of a sudden a lot of interest in BaaS standards from a lot of different areas of the financial ecosystem. And so, what got me thinking about this was on the same day, the Innovative Payments Association released BaaS
Mm-hmm.
guidance, and a an op-ed appeared in American Banker announcing the Coalition for Financial Ecosystem Standards, which is an industry-led group that would work with fintechs to come up with operating standards or practices.
Mm-hmm.
And I just was, and I know that you and I probably were batting around over the summer.
Mm.
I mentioned a FINRA for fintechs, and
Yes, you did.
you have published about national fintech charters, and so it's very
Mm-hmm.
zeitgeisty right now, and there are a lot of people who are publishing, kind of their thoughts,
Mm-hmm.
and they are not doing it to the bank regulators; they are just doing it to the ecosystem. They're just releasing it into the wild. And I find it very curious and interesting that this is happening. It's happening all at the same time. And, I both know what's behind it. Like I understand what's motivating and driving this. And I also think like how successful will any one of these be if we have so many things actively competing for attention and information, and if we have like different fintechs like following different guidance and things like that. So I just kind of wanted to just notice that this thing is happening, and it's a big conversation all happening, but a lot of people they don't seem to be talking to each other. They're just kind of publishing their thoughts or what they think is best. What do you think?
Yeah, I've noticed the same trend, and it's definitely something that's been bouncing around our text message groups. I think for bank nerds. Yeah, I mean, you were, I think, maybe the first one I heard sort of say the like industry-led standard setting as a potential outcome from the Synapse
Which is
mess.
FINRA. Yeah.
Which is what FINRA does in the securities space. And what's interesting though about FINRA is that it's a pretty robust organization from my understanding, right? Like it's, as I understand it, it's actually the merger of several different organizations that were doing that over a fairly long period of time that have sort of all been lumped eventually together into FINRA. They do have some sort of semi-official blessing from the SEC.
They have something with the SEC, which is the regulatory body. So they kind of are commissioned by the SEC or tasked by the SEC to do something. So you follow what FINRA says because they have been empowered by or deputized by the SEC.
Right. And I am not being a lawyer. I can't speak to like exactly what that sort of blessing does or does not do. But in general, like it's seen as the SEC sort of allows them to kind of do the initial policing. And my understanding is that FINRA is pretty active in what they do. Right. It's a lot of different kind of programs, trainings, compliance, certification, exams, supervising. They have the ability to levy fines against folks who
they can ban people.
Yeah, they can ban folks. They have a whole arbitration process, and so it's a pretty robust self sort of supervisory organization by the industry. Maybe the stuff that's happening right now with IPA and I guess CFES, I don't love that acronym, Kiah. Maybe this is like the first little baby steps towards forming separate organizations that eventually all get lumped together into one, and we end up with a non-bank equivalent to FINRA. But I think to your point, the thing that concerns me or I find a little weird is it does seem like these initial efforts, they have more of the flavor to me of like, well, we have to do something. We want to try to get ahead of any like overreaction from the regulatory side. But, we also want to make money doing this. And so maybe like in the case of CFES, I believe they're sort of affiliated with FS Vector. Maybe this can be like a way that we generate more consulting work for ourselves. Like it seems like this is more being done for sort of some combination of like self-interested and short-term reasons, as opposed to, I think what I would like to see, which is more of a, hey, let's set all of our sort of parochial differences aside. Let's recognize that like, we all have to pull on exactly one oar for this to work and for people to take this seriously, which by the way, I don't think bank regulators take anything that fintech does from a sort of policing ourselves standpoint very seriously.
It's just so easy to be cynical here. I as a journalist, I'm like pretty pessimistic anyway, but I agree with you that the timing, I don't think the message is wrong. I think the timing is wrong. Or the timing leads me to be suspicious about the motivations and therefore the actual interest in doing the right thing, not getting banks in trouble, not getting ourselves in trouble. There is, I think that if I removed the names of this guidance and published and went back into a time machine 2 years ago, 3 years ago, and published this guidance, published even like thinking about like even publishing the FDIC's Synapse Hendricks rule. It would have been ignored. It would have been, totally. I think there are parts of the fintech industry, maybe even parts of the banking industry that said this is not necessary. that it's fine that we have the market will regulate this and be efficient, or the existing rules are sufficient and no one's going to mess up that bad. And so
that's not a stretch, right? I feel like that's like a very reasonable statement. And particularly when you see, and I'll pick on a specific company here because they drive me a little crazy, but like Mercury is a part of this CFES, right? And like when they announced that, they said, we're joining this because we take compliance very seriously. And it's like, all evidence to the contrary, right? I'm sure you feel differently about it now than you did before, but it's hard to take it seriously that you genuinely care about this when we have documented evidence from our friend Jason Mikula, as well as other reporting that's been done across the ecosystem, that you don't really care about this, and that you only care about it to the extent
you didn't care about it back when
you didn't have to.
And there's just a little something that strikes me as I'm so suspicious of something that seems insincere, even if they're doing the thing that I think is right, and that. And also I just kind of wish you would say that. Like, I kind of just wish you would say, back then we cared a lot more about growth than we cared about compliance. Totally. We have seen the errors of our ways, and we understand as a leading fintech who has bank partners that are under consent orders. And it is
sorry guys, our bad.
and to my point about fintech, liability of the fintechs, that it is possible these fintech partners directly contributed to the weaknesses that regulators identified. And I would like to see those fintechs be financially responsible for the remediation efforts that the bank will have to incur to fix these, because I believe that is part of it. And I actually want to see that. I want to see a cost sharing in these industry best practices, that if you can join these, sorry, I know I'm ranting. This is
no, you're good. This is good.
But what am I supposed to think if I don't see that in these industry standards? What am I supposed to think about the seriousness by which these fintechs want to hold themselves to, the liability, the accountability, if I don't see the saying like, hey, if our bank partner gets in trouble because of something that, like, our process, our partnership with them created a deficiency, created a weakness, meant that they very quickly grew beyond the scale of their compliance. Yeah. Here's what we're going to do. We're going to split the cost 50-50. And I don't know if that's like realistic or not, but I can't think, like, it doesn't matter what your practices are if I don't see the accountability. And I can't take them seriously when I know in the past something else was more important than this. And it seems so desperate. It seems so like, I promise I fixed it. Can you please just not kick me out of the house or something? You know what I mean? Like,
I do.
And the other thing too, and I need you, like, are we all also not seeing that fintech is moving in the direction of AI and money is leaving this space? And so what is the long-term viability of some of this? Like, where's the actual energy? Whereas there's so little, this is so literally like not interesting to the VCs anymore. So what are we, why are we even doing this, right? Like, we know the VCs are moving on, and the fintechs are actually responsive to the VCs. So why are we spilling so much ink and energy and oxygen to these like better late than never standards that don't even have, they have one, okay, I'm going to just say it. The CFES has one firm proposal right now. Alex, I want you to brace yourself.
Okay.
It is that fintech employees need to receive annual compliance training. Did we fix it? Did they fix it?
Sorry, I didn't mean to laugh uproariously.
Alex, this is serious. This is an industry-led standard. They're going to fix it. That's how they're going to fix it, with annual compliance training. That's what's been missing this whole time, apparently. And I'm sorry. I'm having such a hard time taking this seriously. I'm so annoyed about this. Also,
no, it's fair.
How many articles have been written about this? And there's one proposal, and it is not serious, and it is not enough. And at the same time, am I learning from this that this is also not the best practice? Like, when we read about the Henricks rule and we're like, oh, I guess that wasn't a best practice, but it's a lot of work to do the best practice. No, this is not a lot of work to do the best practice. This is bare minimum. This is not best practice, right?
Compliance training. So, all right.
The ceiling is the floor here.
I totally agree with you. No.
An early rant.
That was a very good rant. I mean, we got to the rant early. I couldn't agree more. I mean, so just to put a fine point on a couple things of your epic rant, which was great. I think that what we should be thinking about are what are the specific things you're going to do differently or pay to do or do things that are uncomfortable that demonstrate how serious you are, right? And this is like kind of classic relationship management type advice where it's like, I can tell my wife I'm sorry when I screw up, or I can do something that really truly demonstrates how sorry I am. Like one is kind of good, but kind of doesn't really matter that much, especially if I really screwed up. The second one matters. And so I think to your point, like show me a set of proposed standard like contracts, for example, that split liability in a way that allows the fintech to have more accountability in these relationships.
Yeah.
That would be you demonstrating, hey, we're going to hold ourselves to a standard that's much higher than we typically were, and we're going to take some pain to show how serious we are about this. Another one that you touched on there that I think is absolutely totally fair and a really good question is, it wasn't just Mercury saying, hey, we need to grow as fast as we possibly can. It was Mercury's investors pushing them to say, hey, we need to grow as fast as we can and potentially disregard some of these compliance obligations that we find annoying. I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com. I would take these standards a lot more seriously if it was also announced that Andreessen Horowitz was going to be contributing $50 million to this new organization. Like, show me that press release, and then I'll start to take this more seriously. And then the last component of it that I think is really important for setting standards is you can't let everybody into the club, right? And so the other thing I would have really liked to have seen, and honestly, maybe this is still coming from some other group or something, is I would like for all of the fintech companies that have been doing this the right way and have scaled up slowly and painfully by actually taking compliance seriously and who have never gotten their bank partners into consent orders to band together and say, we're not with those guys. We're the ones who are doing this right from the beginning, and we're forming our own standards organization. And when Mercury comes to knock on the door and say, hey, can we be a part of your club? They go, fuck off. That would be something that would make me feel a lot better and take these things more seriously. But I share your pessimism and your skepticism about these efforts because, after you get in trouble, the words "I'm sorry," which is essentially what we're seeing here so far, really don't mean much by themselves. And so maybe this is the beginning of a longer process. Maybe there are more firm proposals to come out from some of these organizations. Maybe we'll see other organizations form. Maybe some of them will merge over time. Like maybe. But I think that a natural skepticism and even a rant occasionally about it is very warranted given the scope of the mess that we're standing in and the lack of seriousness with which a lot of these companies treated that mess right up until it became super evident. Is that fair?
Yeah, and I would be remiss if I did not mention that Alloy Labs has the BaaS Center of Excellence, which has been in existence for 5 years and is on, I think maybe version 3, version 4 of their BaaS guidance, which is, I think what's great is it's a living document that should be updated to reflect, risks, technologies, approaches. And so there is, it's not they're
I haven't
like
read about that one in an American Banker op-ed. Is it
not,
possible they were just busy doing the
not
work and not talking about
everyone
it?
has. Yeah, we're trying to get Jason to start writing some op-eds.
We need to, I
He's
know.
too busy working to write op-eds, I guess. I don't know. But to
Apparently.
say that, like, you know, I think that one thing is when you feel like you've been beating a drum for so long, people don't even hear that drum anymore. But when someone else picks up the same drum and beats it, there's so much attention and energy that also, kind of, I think that there are some legitimacy issues there, and that, that you should maybe listen to the person who's been saying this the longest. But that's not really how media works, unfortunately.
It's really not.
So, props to Jason for being right, continuing to be right, having an eponymous rule potentially named after him.
I know this is a big podcast for our friend Mr. Henricks. He's doing very well in this one. All right, I think we put a capper on that one. Kiah, since we got our rant out of the way, I think what we should do is just pivot into the two questions, the possibly unanswerable questions, the maybe eternally unanswerable questions in the case of yours that we wanted to talk about. Would you like to go first?
Yeah. So, Alex, I was wondering if you know what a bank service company is. And I'm asking you because I was on your show when we talked to Jim about.
I like to think of it as our show, Kiah. And we talked to Jim about
the Bank Service Company Act, which is a law that regulators have access to. And we talked about the, at the time, why that law was passed and what that law was, what was a bank service company at the time. And I think something that, having established that, the real question now is, there's so many companies that work with banks. And some of them the bank uses for the bank's operations. And some of them the bank uses to offer to customers and interact with customers. And there is one of the things is, so would both of those types of companies be bank service companies? Would neither of those types of companies be bank service companies? So anyways, I wanted to pitch that to you to talk a little bit about what is a bank service company, because everyone is talking about it and everyone else seems to know what a bank service company is except me.
Well, you're not alone. I will just give my answer right off the top, which is I don't know either. You and I have been asking this question. Jason Mikula wrote about it over the summer, sort of posing a theory of the case, I suppose, about what the Fed and others who are empowered, I guess, under the Bank Service Company Act to oversee some of these non-bank companies, that they could have potentially applied that to Synapse and to some of these other fintech companies. But it's a really hard question to answer. I mean, I will give us credit, Kiah, for at least putting this on the radar of people. I'm seeing BSCA mentioned so many more places than I used to. And so I think we should congratulate ourselves for another successful Finfluencer campaign. My goal of getting the prudential banking regulators to adopt my unicorn rating for companies
for
under
bank
the BSCA.
Service companies.
Yeah, I don't know that has happened. Yeah, but that might be a bridge too far. But at least BSCA is being talked about, and we're asking this question: what is a bank service company? I think one thing that's important to layer onto this discussion is the historical context, which Jim shared with us. Just to recap briefly, but when the BSCA was first sort of put in place, the notion of a bank service company was literally small banks who couldn't afford technology to do things like process checks, as an example, would literally pool their money together to create entities where they could invest in and create technology that banks could use, right? So they literally were owned by banks. Those were bank service companies. However, the modern sort of history of fintech, and I say modern sort of in quotes because it's been going on for 40 years, is that a lot of those initial efforts to provide technology to banks have spun off into very profitable standalone ventures. So I would argue, I think, that Not all bank service companies are owned by banks. In fact, I would say that most bank service companies are not owned by banks these days. But Kiah, the thing I'm confused by is, there is no published list of who the bank service
Right.
companies are that have ever been sort of examined under the Bank Service Company Act. There have been some disclosures by some of the companies that they are regulated under the BSCA. So, for example, we're fairly confident, I think, that the big core banking providers like FIS and Fiserv and Jack Henry are bank service companies. I think that the recent sort of extension of the BSCA into the world of cloud computing
Yep.
following the Capital One data breach was another example of regulators kind of saying, oh, hey, look, bank service companies, we hadn't noticed you sitting over there, but now we see you. So occasionally we get little glimpses of companies, I guess, formally being designated as bank service companies. But then I hear things like, for example, we had sort of like a little bank nerd chat going where one of the statements in the chat was that EWS, Early Warning Services, has argued that it's not a financial institution and not subject to Reg E, which got us thinking, is Early Warning Services, which is literally owned by banks, it's owned by a consortium of big banks, are they a bank service company? I don't know, Kiah. I don't know.
Yeah, is the clearinghouse a bank service company? Is we could just do
Sequoia
this all
a bank
day.
service company? We really could.
Yeah.
Are the credit bureaus bank service companies? I would
Right.
assume they are, but I don't know.
Well, and yes, congrats to us for making BSCA a thing, but
It's sexy now, for sure.
I guess what I had hoped when I talked incessantly about it was that someone would tell me and then I would know. And what
That's not
has
gonna
happened
happen.
instead is what we and what I think is so interesting about the BSCA is when you hear Bank Service Company Act, you're like, oh yeah, that definitely applies to X, Y, and Z thing based on its name. And you're like,
Yes.
I'm totally with
They
that
provide
logic.
services to banks.
But you would be so surprised based on how the statute is written. And so, I feel like, we popularized it enough that now many people are using it and just lobbying it around. And then when me as a reporter has to say, wait, does that person know about the BSCA, or are they just talking about it based on the words Bank Service Company Act? And they're like, well, this obviously apply and clearly applies, because I still feel like I do not know what is a bank service company because of the idea that services are provided to the bank or services are provided through the bank, which is really kind of where that distinction falls down. And so,
that's where
I think
the ambiguity is.
Yeah. So Makula argued very persuasively that if these middlewares say that they function as a ledger for the bank, you could say that is services to a bank.
Mm-hmm.
But for a little bit, the middlewares, previously in a past life, like a whole year ago, they argued that actually what they did do is provide services to a fintech, and the banks were the vendor. And that's not services to a bank. That services through a bank. You see how it can get really muddled really quickly.
Which is strange, though, because the from a third-party risk management view of the world, they were always vendors of the bank and subject to third-party risk management, even though they were selling to fintechs and treating banks like service providers. So it does get really confusing, because to a degree, it's like, how do you talk about your services versus how would a bank regulatory agency under a framework like third-party risk management view your services? And I think the other thing, Kiah, and correct me if I'm getting any of this wrong, but my general understanding of how bank regulators even start to approach trying to answer this question is they require their banks to share a list with them of all the, I guess, third-party service providers that they work with.
And kind of, you'd hope that there'd be some prioritization of the key vendors.
Well, yeah, you get the lists from everybody, and then you're like, wow, this FIS company seems to come up a lot. We should maybe think about looking at them. But the other, I think, complicating factor here, if I'm remembering the conversation with Jim correctly, is that there is really no implementing rule for the BSCA. And so one of the challenges is that, as we're saying, the statute is a little unclear, and it's antiquated because it was written in a very different time. And I guess in a post Chevron world, it might be difficult even to create an implementing rule that wouldn't get challenged and potentially thrown out by the courts, because that ambiguity wouldn't necessarily
It's got to go back to
clearly
Congress.
designate the authority. Yeah. And it's like, if we have to send this question of what a bank service company is to Congress, I don't know that we're ever going to get an answer.
You know, it'd be so funny if so when we say implementing rule, the way I think about implementing rule is, if you're familiar with the broker deposit rule, that rule comes from Congress. There has to be a definition of broker deposit. There actually has to be, Congress has also passed, as part of FIREA, the capital treatment. The FDIC does get to determine what is a broker deposit. So that's kind of the implementing rule of the law. So when we talk about the broker deposit rule from the FDIC, we are always just talking about the FDIC's interpretation of this law. And so the BSCA, I have been told, also does not have an implementing rule, which means that we actually don't get to look at the FDIC or any other regulator's interpretation of this. We just have to go to the statute itself, which makes having Congress potentially needing to weigh in on this, 70 years after they passed the law, hilarious. The other thing too is I would also like connecting this topic to our previous topic about the fintech standards is do you think the words BSC or the letters BSC is going to appear in any of the governing documents of these like standard groups? Right?
It'd be nice if they were. Right? Well, I mean, here's another proposal. Maybe the companies that are in a position of influence in whatever this standard setting organization are the ones that actually already are supervised under the BSCA. How about that? Like, if
I don't know if Mercury provides services to a bank or through a bank.
Well, and I guarantee you they're not supervised by under the BSCA. That would be my strong suspicion. And, it creates a level of uncertainty that is, again, really unhelpful, where it's like, if regulators want to consider something under the BSCA, it seems like they have kind of the flexibility, at least they have historically, to be able to figure that out. But I think the other thing that's really interesting about this is now everybody wants to be a bank service company, right? Like, that's in a world in which regulation becomes much more stringent and compliance becomes like a virtue and a signal of like how serious you are and how safe you are to work with. Suddenly everybody can't wait, I think, to either talk about the fact that they already are supervised under the BSCA, or that they want to be, and they're like asking proactively for that to happen. And, I think the other just little point of clarity that's important here is, whenever you and I ask for these things, I always am reminded by our friends who work for regulatory agencies, where they're like, do you know how busy we are and how little time and staff we have to do this stuff? And so, like, in my ideal perfect world, I kind of want any fintech company that does things through or for a bank to be regulated under the BSCA, supervised. Like, that's my dream.
There's a lot
but
of
obviously them. There's a lot of them. That's not practical. And so the question is really like, where do you draw the line?
Yeah.
And then which buckets of risk, I guess, are we concerned about? And I mean, BaaS middleware platforms would be the obvious one that I think we'd be concerned about these days. But, even things like this comes up a little bit with like 1033 and open banking, actually, because there's all these questions about, okay, well, who's going to certify the third parties that are getting access to consumers' data? Is this a good third party that the consumer should be trusting? And no one really wants to do that certification work. Like, the CFPB doesn't want to do it. The data aggregators don't really want to do it. The banks certainly don't want to do it. We can't trust consumers to do it. And so you could even see overlap with something like the BSCA over there, where it's like, if you're not considered a bank service company, should you be able to get permissioned access to consumers' data? Probably yes, but at least that's an interesting question. And these things are sort of coming together in a way that I find fascinating.
Yeah. I mean, I know that regulators are very busy. I know everyone's very busy, but
you and I are busy.
I'm just going to beg that all chatter around the BSCA and a BSC, actually, like, you need to say, as part of whatever you're going to say about the BSCA, what you consider to be a bank service company, and whether and to discuss kind of where you see that supervisory parameter or that definition align the boundary of what what type of non-bank counts as a BSC for supervisory purposes and which type doesn't, because I just want to kind of know where people's heads are at, because I don't fully think, I think we've moved past this, like the place where we should talk about, which is what is a bank service company. We've just moved on and just said, yeah, banks, regulators have it and they can supervise all these banks non-banks. And we're just not there yet. We're just not there as an industry yet with this kind of consensus.
No, I completely agree with that. It is funny to me, Kiah, how so much of your sort of viewpoint on all of this stuff is colored by how annoyed you are as a reporter when having to deal with it. So just give
Look,
Kiah
I'm very
a break.
busy, and if you could just make my job a little bit easier so I didn't have to keep digging in.
That would be nice.
That would be nice.
I mean, my thing on this whole thing is, let's just publish the list. Just publish it.
Yeah.
You know what I mean? Like
so much.
And this is not like banks where we're going to create a systemic issue. It's weird, right? Because I think sometimes in a regulatory context, we get used to secrecy and we sort of assume we need secrecy everywhere. But the reality is, like, that's why bank runs happen, right? That's why you have this sort of prohibition on sharing a list of troubled banks, is because we're concerned about that risk. That risk doesn't exist with bank service companies, I don't think. Like, what is someone going to short their stock if they aren't considered a bank service company? Like, I don't think that same risk applies. And so my plea would just be, publish the list and let us see it. That would be amazing.
We got the master account list, so maybe we can get this one.
Maybe if we're loud enough on Twitter, we can bully them into doing it. All right, Kiah, can I ask you one quick question before we go?
In the outline, it's me.
No, I'm going to ask it. I'm going to ask this question.
Okay, fine.
Now you get to answer it because you asked the last question, so I'm going to ask it, and that's just how it's going to be. All right, Kiah, my question for you is a very, very simple and yet profoundly difficult question to answer. What is a loan?
Interesting question. That's a pretty good question to ask a bank reporter, because that is the product that banks sell. They sell loans to consumers and businesses. And it's very important to make money off of loans. And loans look in banking kind of like certain flavors. And many of them have a term duration. Some of them are for a certain amount of money, a set amount, and some of them are kind of credit lines that are also for a certain amount. But you don't have to use all of the money up at once. They have a price, which is in the interest rate that is used, or that the borrower pays. They have,
as well as fees.
Yeah, they have fees. They have repayments. They have the repayment cadence is often a month, but I guess doesn't have to be a month. And that's kind of most loans at banks. I've just described maybe 90% of loans, but there are, what I am understanding to be products that kind of look like some of what I've just described, that are or are not loans, and we are just and that there is a regulator and agency arguing that these products are loans. So
let me ask you about some of those, because so you have your definition of a loan, which you did a great job of describing. I think that generally does cover most of the market. But let me ask you about a couple. So Kiah, I want to give you money to buy some product online. It's not going to be a huge amount of money, say $200. You are going to pay me 25% of that loan that I'm giving back to me immediately, as soon as I give you the loan. So I'm essentially loaning you 75% of the money that you need to buy this thing. I am then going to ask you to pay me back, not on a monthly basis, but on a 2-week cycle.
Okay.
I am not going to charge you any interest.
Okay.
I may charge you a late fee if you don't pay, or I may not. I will not furnish your repayment data, positive or negative, to the credit bureaus. I may try to collect on the money that you owe me if you don't pay me. And I will
which I'm
likely
agreeing to, right? When I take out,
you are agreeing to all of these terms.
I am also agreeing to that. Okay.
Correct. And let's just call it like a term that's been used forever in the industry, but I think it'll be sexy if I introduce it again. Buy now, pay later. Let's call it buy now, pay later. BNPL for short. Is BNPL a loan, Kiah Haslett?
Okay, what in my like legacy reporter, no imagination brain, that is a loan because, and the main thing I would
Okay.
say is
Yeah.
that you have given me money I don't have, and I am expected to repay that money back. That is like, to me, a loan.
That's a loan. It's a loan.
And it's
Yeah.
okay.
Okay. So the
And it's
fact,
just because you didn't charge interest doesn't mean that it's not a loan.
right.
Yeah.
Okay, so just because I didn't charge interest doesn't mean it's not a loan. Just because I'm not furnishing the data to the credit bureaus doesn't
Yeah,
mean
that's
it's
just
not a
money
loan.
between
Okay, all right.
friends, man. Like that is just
That so like when family or friends loan you money, it's still a loan. All
they're
right.
not telling the credit bureaus how good I am at repaying
No,
them.
no. Well, I hope not. Anyway. Maybe a brave new world we could create that. All right. Another test for you then. So this is actually money that you have. This is money that you have earned through your job, but because of the peculiarities of the U.S. Capitalist system that we have, you're not going to get that money for a couple of weeks. But you've earned this money, you've worked for it, and I am going to advance this money to you, Kiah. I am not going to require you to pay me a fee. I am going to give you the option to pay a fee if you want the money quickly, if you want the money instantaneously rather than waiting a couple days. I am going to charge a small, very reasonable fee. I also am going to ask you for a tip because Alex Johnson Enterprises is offering you this service. And for us to continue to offer this service, we would really appreciate a tip. We'll leave it up to you. We'll maybe make a suggestion about how much it would be nice. I will tell you that we're going to donate a specific portion of the tip to needy children somewhere around the world. And I'm going to show you a picture of the needy children. So just keep that in mind. I am not going to try to collect on this if you don't pay.
If I don't pay a tip.
I am not going to charge just if you don't pay at all. I'm not going to not going to try to collect if for some reason, like let's say your company screwed up and they told me that you'd earn this money, but you actually hadn't, or maybe the company goes out of business before they can actually pay you for that pay cycle. And I end up out the money that I advanced you accidentally. I'm not going to try to come after you for that. I'm not going to go into collections. We're also not furnishing any of this data to the credit bureaus. Kiah Haslett, is this this thing where I'm like giving you access to your wages early, like I'm advancing your wages? Is that product alone?
Okay, there's something so broken in late capitalism that giving me money that I have earned in a faster time than a regular
and asking for a tip
is would be considered a loan, right? That honestly, I'm loaning my company money by agreeing
right.
contractually to not get my money every day
Yes.
I have worked, but instead
Yes.
I am
Bank
graciously
director thanks
allowing
you.
them to every 15 days give it to me because of how the cadence of receiving money from my company receiving money from the people who owe us money, right? And so I am merely reflecting that they don't get paid by their the people who owe them right away, so I don't get paid right away. But no, that's not a loan. And also it's weird that you've asked me for a tip to give me access to my own money.
Well, you and I could not be more in violent agreement about that last point. Okay, this is an interesting little experiment that we just did because I don't really disagree with anything that you just said. I find it to be fascinating because obviously the CFPB considers both earned wage access and buy now pay later to be loans from a Reg Z truth in lending perspective. They want to see the costs of those loans disclosed to consumers in the way that we disclose the cost of all loans, which among other things includes calculating a APR. Those APRs are going to look not great because of the short-term nature and small dollar nature of the loans themselves. In the case of earned wage access, it actually may trigger state level usury caps, which might require those earned wage access providers to start working with the bank.
Why would EWA even carry APR? I genuinely feel like the dumbest person ever
Well, I
whenever
mean,
I
I
read
asked
about
that question
these
in my newsletter.
fintech
Like, I
banking
don't,
products.
they're like, hey, so you advanced
You
yourself.
didn't advance it, you
uh,
earned it. That's your
yeah.
money.
Like you are getting a portion of
There's
your
no
money, say
credit extension. Tell me how this
$100.
was earned.
Right. So you're getting $100 early, and you are paying, I don't know, $4 for that. And that is a 190% APR. How does telling me that's 190% APR meaningfully inform the
Yeah.
choice that I'm making here? Like, I just don't understand that at all. I mean, I think tipping in fintech is horrific, but like in the case of the fee you pay for the quicker access to the funds, like that seems like a very clear, easy to calculate in my head cost
Yeah.
benefit of, do I want to pay $4 to get $150
Yeah.
now? Well, depending on what I need the $150 for, yeah, I might want to do that. So I find that really interesting. I also find the other thing kind of fascinating here, which is which of these products, earned wage access or BNPL, do you think is better for consumers if you had to pick one?
Um, I mean, I think they're both better than traditional credit or credit cards, and they are better than overdrafts.
Yes.
So I would say that both of these products are better than traditional financial products.
Hmm.
I would think EWA is better than buy now pay later, just from a kind of a consumption smoothing perspective, and
Hmm.
the idea that many people overdraft in part because of the timing of their expenses relative to the timing of their paychecks.
Hmm. No, I think that's very fair. And you put your finger on something with buy now pay later that I continue to kind of think about and be concerned about, which is like, it is better than credit cards, I think, in a lot of ways, but it's also sort of structurally similar in some ways to credit cards, in that the incentive is to drive consumption behavior that might not be in the best interest of the consumer's overall financial health. Whereas getting earlier access to money that you've already earned does feel a little bit more like, I guess, just financial management on the part of the consumer. And again, like I sort of live in this world of, I think that earned wage access should sort of go to zero from a cost perspective over time. Like I just want to see this offered as a benefit on the part of employers
I know it's
who've been
not
getting
free
these
to
free
offer
loans from
it.
us for a long time.
I get that it's not free.
Cost
Yeah,
money.
and
Yeah.
but it is one of those things where it's like, just because it costs money and so you have to kind of cover the costs somehow, doesn't mean it's like an interest rate, or an
Well,
APR.
no,
Like,
it doesn't mean that at all. And I also think the other thing with the charging for the money thing is, I kind of think there are just areas where someone just needs to eat the cost of this. And again, I kind of think it should be employers. I think most employers would disagree with that. Maybe it's banks, right? Like another thing I've thought a lot about is, if you look at like kind of what Chime is doing, this is just sort of being built in as like a feature of Chime and a way for them to build relationships with employers that work with their target customer base. So maybe it's like, just this is the way that checking accounts work in the future, is this is just kind of a built-in feature of it. But to me, any of the problematic aspects of earned wage access relate to the non-employer sponsored, non-employer integrated model, where it is much more of a like loan. And in that environment, I don't know that you've worked a certain
yeah,
number of
it's a
hours
loan
and I'm
because we
advancing
don't
you the
have the
funds.
direct connection between the employer and the employee. You
Correct.
have,
Correct.
right, the person who would be receiving the
Yes.
funds is reporting that they have
Yes.
basically worked X, Y, and Z and expect to receive as a result Y dollars. And then
Hmm.
the company is saying, okay, well, if you're going to receive Y dollars in 2 weeks, we can give you Z dollars today, and it will cost you
Yeah.
X amount of Z, whatever. Sorry,
Yeah.
I'm getting
Yeah.
all
No,
mixed up.
exactly. No, that's right. That's exactly right. And, again, I think it's something that we can solve with technology over time, right? Like something that the earned wage access companies, I think, are pretty interested in actually is the expansion of 1033 and open banking to cover payroll data, right? Because if payroll systems were sort of open and consumer permissioned by default, that would allow everyone to have a more sort of granular view into how many hours I've worked and how much money I've earned. And then it's really just a function of like how you design a checking account, kind of in the same way that 2-day early access to your paycheck works, where they're advancing against the ACH transaction, like there's zero risk there. And so I think that as a model is very, very different. Last thing I wanted to ask you about, Kiah, before I let you go, is on this topic. What do you think about the sort of reflexive approach of both the CFPB and consumer advocacy groups, whose heart is in the right place, that any sort of lending innovation, earned wage access, BNPL, you can go down the list, is really just a different form of payday lending and should be discouraged at all costs? Like, what's your sort of general thought on that line of thinking?
So I'm kind of skeptical. I think that the impulse to say things that cost consumers are bad for them is probably you should resist that framing, or you should interrogate that framing as much as you interrogate the thing that costs the consumer itself. It kind of goes back to our question last week or last month about what role do these products play in the financial health of customers, and what gap are they filling in? And just because the product is filling in a negative gap and has, an incrementally negative impact to the customer, it doesn't necessarily mean that the product itself is bad, rather than maybe the environment of the environment of the consumer itself is negative. I also think that I kind of question the good versus bad framing as well. I also think that going back to like APR, I just wonder how much of our understanding of these things is based in kind of a legacy bank product mindset, and that as more of these products come to market and they kind of subvert some of the traditional credit underwriting that banks would have had to use to issue these, we might just need different yardsticks, different measuring sticks. That if you have a loan that has 12 repayments over 12 months, an APR might be a great way to measure the cost of that loan. And if you have a loan that is 2 months and 4 repayments, maybe there's a different way to measure that gives us a more informed view of that and helps consumers make more direct comparisons. But I think I'm kind of a traditional bank person, and that people saying these products are bad, I kind of always just am like, compared to what, and what's your solution instead?
It's the first question you should ask.
At a certain point, you can't like give the product away. Like, to your point, all of these are going to have a cost. All of them have a risk, right? Payday lending probably has really, really high loss rates, and
they price it to risk,
and is probably priced appropriately. And I think many people who use payday loans, like I would gander to say more than 50% of them know that these are expensive, financially punitive products, and yet have decided that this is a good product that's for them today.
Well, and I think to your point, I agree with that. And I think the point really, and I've written about this before, is all these products should be designed to be misused in the least amount possible, right? Like, to me, a good metric for this is how many of your customers are using this product the right way, quote unquote, and how many of your products are using this in the wrong way, but in a way that benefits you financially in an outsized way, right? And obviously, you have to cover your costs. You have to be able to make money as a business. This isn't charity. And you have to be able to manage your risk and price your risk effectively. But beyond that, my question is always like, structurally, what are you doing that might make it more likely for customers to pay much more for this than they should, or to fall into a repeated habit of usage that's good for you and bad for them? So like, where do incentives diverge? And the thing that I generally like about the direction of a lot of these fintech innovations, whether it's buy now, pay later or earned wage access or whatever, is they are adding more rationality to the sort of toolbox of how consumers use these products, right? And like credit cards versus buy now, pay later is a great example. Makes a ton of sense to use a credit card if you don't revolve a balance, or if you revolve a balance only occasionally when it's used to cover expenses that you kind of need access to credit for. But even in that scenario, it's probably better to get like an explicit loan for whatever you're trying to finance, rather than to pay credit card interest rates to revolve an overall balance. And so we're already seeing credit card companies, by virtue of competition, having to add in BNPL features into their cards. And what's really interesting, if you look at the data, is that consumers are using those features, and they're using them in order to use credit cards in a more rational way. And so I always kind of come back to, like, are we adding a product that's going to help consumers use credit in a more rational way? We can't, to your point, expect that consumers are just going to say, yeah, you know what, I'm never going to take out credit ever again, right? Because I think it's just kind of a fundamental misreading of the society we live in, the costs of living in that society, and like the reality that, for better or for worse, and you could make this argument either way, America is just a very credit heavy culture, right? Like, we're not the Netherlands. Like, that's just not, we use a lot of credit. And that by itself, I don't think is a positive or negative value judgment. It's just the state of the world. And we should try to design products for that world. So I think I agree with you.
Yeah. And, I actually have a friend who uses a credit card that has the buy now, pay later functionality. And it is interesting to talk to her about the expenses that she has decided to put into the buy now, pay later, and the expenses that she has decided to just keep on her credit card. And I think having some curiosity about why people make the decisions they make, and whether they think that those are optimal decisions, again, not good, not bad, optimal and suboptimal. Hopefully will give us more data and help us create a better financial system that works for everyone. I think that, and it's not lost to me that when Fifth Third had kind of a payday style loan product that, the CEO, before they discontinued this product due to regulatory scrutiny, said that he has never seen demand from consumers for a product like this. And so, it is interesting to think that this product was popular. It was competitive with, but supposed to be better than, a payday loan. And regulators decided that was bad. And then what? What did consumers get in response to having this option taken away from them? And who was helped by this? And are consumers really acting in the best interest of banks or of consumers when they do stuff like this?
No, I couldn't agree more. I think having more curiosity generally about these things would be very beneficial. Thank you for talking that one out with me, Kiah, because I now feel like I have a better understanding of what is and what isn't a loan. We already ranted, so we'll just leave Bank Nerd Corner there. But Kiah Haslett, I am sure that I will run into you at some point down the road. You're not going to Money 2020, right?
I have so much fun in the desert and your basketball tournament.
I will. I will report back on how the basketball goes. I will say hi to our other bank nerd friends for you, and we'll be back at this next month.
All right, sounds good.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.